Welcome to the deep dive. Today, we're really getting into something crucial for anyone watching the markets. How do those big economic drivers, things like interest rates, inflation, GDP, and, the decisions from the government and the RBI, how do they actually shake things up in the stock market? You're likely here because you want to get past the headlines, understand the real mechanics affecting your investments, maybe just the wider economy.
That's exactly it. And we've looked at quite a bit of material, especially drawing insights from Miss Mancy's explanations. She really covers that intricate connection between these key indicators, government action, and what happens in the market, even down to sector specifics and, examples using Indian rupees.
Right. So, our mission here in this deep dive is to pull out the most critical connections. We want to show how these factors are like the pulse of the market, and importantly, why some sectors react one way and others, well, completely differently. Okay, let's dive right in. Interest rates. Fundamentally, what are we talking about here?
Well, think of interest rates basically as the price of money, the cost of borrowing it. Central banks, that's the RBI here in India, or the Fed in the US, they play a huge role in setting these benchmark rates. And when the RBI makes a move, it really sends ripples everywhere.
Okay, so ripples. When that cost, the interest rate goes up, what's the sort of immediate fallout for stocks?
Yeah, this is where it gets interesting. Generally, it's an inverse relationship. So higher rates mean it costs companies more to borrow. Now, picture a company planning to, say, build a new factory or open more stores. If loan rates jump, that expansion suddenly looks less appealing, maybe gets put on hold, slower growth potential. And investors, they see that, and they're often less keen on paying top dollar for that company's stock.
That makes sense. It's harder to grow if the fuel cheap money gets pricier. And it's not just businesses, right? Consumers feel this too.
Oh, absolutely. Higher rates trickle down pretty fast. Loans for big things, houses, cars, even credit card debt, they get more expensive. So when borrowing costs more, people tend to tighten their belts, spend less, and if consumers aren't spending as much, well, companies selling stuff see their revenues potentially dip. That can hit their stock price.
So rising rates affect both business investment and consumer spending. But you also mentioned something about how investors actually value companies changing, especially those promising growth later on.
Yes, exactly. This is key. Investors often look at a company's potential future earnings. Then they use what's called a discount rate to figure out what those future earnings are worth today. Think of it like getting promised E100 next year isn't the same as having 100 now, because you could invest the 100 today, right? Yeah. Higher interest rates basically bump up that discount. Why? Because safer options like bonds start offering better returns. So those big future profits, especially for growth companies, just look less attractive now.
Ah, okay. That clarifies the discount rate thing. So that's why growth stocks, often value way out in the future, can get hit particularly hard when rates climb. Which specific sectors tend to feel this pressure the most?
Well, technology often comes first to mind. A lot of tech firms, particularly the ones still growing rapidly, they rely on borrowing money for R&D for expansion. Higher rates hit their costs directly. And like we just said, their valuations often depend heavily on those far future earnings. Those earnings just get discounted more heavily. Think younger tech startups maybe, but even a big name like Tesla, valued on future EV dominance, can be sensitive.
Right, those grand future plans suddenly seem a bit riskier in a high rate world. What other sectors are really sensitive here?
Real estate is another big one. Developers, real estate investment trusts, REITs, the companies owning malls or offices and paying dividends. They often borrow heavily, so higher rates mean higher borrowing costs for them. Plus, when rates rise, those safer bonds look more attractive compared to REIT dividends. Investors might shift money. You could see a major developer like DLF feeling it from both ends, higher mortgage rates for buyers and higher costs for their own projects.
Makes sense. Big property deals usually mean big loans for both sides. What about consumer spending beyond just the absolute basics?
That's the consumer discretionary sector. Very vulnerable. We're talking non-essentials, new cars, fancy gadgets, holidays, luxury stuff. When rates go up, loans for these things get expensive. Plus, people might just have less cash overall if their existing mortgage or debt payments increase. So they put off buying that new car, delay the vacation. That hits companies like Maruti Suzuki or maybe high-end retailers.
So the wants rather than the needs get postponed when money's tight. Any other standout sectors sensitive to rate hikes?
Yeah, utilities can face issues too. Think power companies, water companies. They often carry a lot of debt to fund huge infrastructure projects, power plants, grids. Higher rates mean higher debt payments for them. And another thing, utility stocks are often liked for their steady high dividends. But when bond yields rise with interest rates, those utility dividends might look less appealing by comparison. Investors might look elsewhere. A company like NTPC, for instance, could face higher financing costs.
Okay, so that covers the sectors that generally struggle when rates rise. What about the flip side? Any sectors that might actually do okay or maybe even benefit?
Interestingly, yes. The financial sector, particularly banks, can often get a boost. Think about it. They make money on the difference, the spread, between what they charge for loans and what they pay on deposits. When rates go up, they can usually raise loan rates, mortgages, business loans faster than they raise the rates on savings accounts. That wider gap, the net interest margin, means more profit. So big banks like HDFC Bank, ICICI Bank, even globally like JP Morgan Chase could see earnings rise.
Ah, right. They're selling money and the price just went up. Good
Now,
point. What about sectors that are just, less bothered by rate changes?
consumer staples tend to be pretty resilient. These are your everyday essentials: food, drinks, toothpaste, soap. Demand for these things stays pretty constant, doesn't it? Whether rates are high or low, you still need to eat and brush your teeth. So companies like Hindustan Unilever or Colgate often see stable demand.
The weekly shop stuff makes sense. And healthcare.
Similar story, really. Healthcare needs medicines, doctor visits, hospital stays aren't really driven by interest rates. People get sick, need treatment, regardless of borrowing costs. So that provides some stability for companies like Cipla or Dr. Reddy's.
Okay, so essentials hold up. What about a sector like energy? That seems driven by completely different things sometimes.
You're right. Energy's performance often hinges much more on global commodity prices, oil, natural gas, than on domestic interest rates. If oil prices are soaring globally, energy companies can do really well, even if interest rates are rising back home. So think about Reliance Industries' energy arm, or maybe an international giant like ExxonMobil. Their fate is often tied more to crude prices than, say, the RBI's repo rate.
That gives a really good picture of how interest rates, this cost of money, send different signals across the market. Okay, let's shift gears now. Let's talk about inflation. What exactly is it and why is it such a big deal for investors?
Simply put, inflation is just the speed at which prices for goods and services rise over time. Your money basically buys less. In India, we usually track it with the Consumer Price Index, the CPI. And it's crucial for investors because, well, it eats into the real return you get on your investments. Plus, it really changes how companies and consumers behave.
Miss Mancy's analysis drew a line between moderate inflation, say 2 or 3%, and high inflation, like 7% or more. Why is that distinction so important for the stock market?
Well, a little bit of inflation, that moderate kind, can actually be a sign of a healthy economy. It suggests there's good demand. But high inflation, that's a different beast. It really erodes purchasing power fast, makes consumers think twice about spending. And for businesses, high inflation means costs can shoot up: raw materials, wages, energy. If they can't pass those higher costs onto customers by raising their own prices, their profit margins get squeezed badly sometimes.
Right. So rising costs for businesses, that's a major way high inflation hurts the market. Can you give an example?
Sure. Imagine, say, Tata Motors. If the price of steel, which they need a lot of, suddenly jumps way up due to inflation. Now, if they raise car prices too much, maybe sales drop off a cliff. But if they don't raise prices, their profits shrink. It's a tough spot. And if lots of companies face this kind of pressure, overall corporate earnings across the market can fall, pulling stock prices down.
And then there's the direct hit on consumers you mentioned.
Exactly. When essentials, groceries, fuel, electricity get really expensive because of inflation, people just have less money left over for other things. Less disposable income means less spending on, non-essentials. That could mean fewer smartphone sales for a company like OnePlus, maybe fewer bookings for travel firms. That hits their stocks.
We also talked about interest rates and inflation being linked. How do they usually interact to affect stocks?
Ah, yes, a critical link. When inflation gets too high and stays high, what do central banks like the RBI usually do?
They raise interest rates, right, to try and slow things down.
Precisely. They use higher rates as a brake pedal for the economy, hoping to curb inflation. But as we already discussed, higher rates themselves can be bad for stocks' higher borrowing costs, lower valuations. So high inflation can indirectly hurt stocks by basically forcing the RBI to step on the brakes with rate hikes. We saw that in 2022, didn't we? The RBI hikes in response to global inflation definitely made the Indian market more cautious, especially for growth stocks.
So it can be a sort of double whammy. Inflation itself causes problems, and the medicine higher rates can have its own side effects on the market. You also mentioned inflation changing how investors think about value.
Yes, it comes back to that time value of money again. If inflation is high, a rupee you expect to earn next year is worth less in today's terms. Its buying power gets eroded. So investors become less willing to pay a premium today for companies whose main value lies in profits expected way down the road, like tech startups. The risk just feels higher when future money is losing value faster.
Okay, so which sectors are generally the most vulnerable when inflation is really cooking?
Technology, again, often feels the heat. Their valuations rely on those future earnings, which get discounted more heavily. Plus, R&D costs might rise with inflation, and borrowing gets more expensive if rates go up too. So that could affect big IT players like Infosys, maybe, or even newer firms like Zomato.
And consumer discretionary, the non-essentials. We saw they were sensitive to rate hikes. Same with inflation.
Absolutely. If the price of roti and dal goes up, buying that new gadget or planning a holiday gets pushed down the list. Less discretionary income directly hits sales for companies selling cars like Maruti Suzuki or travel firms like Make My Trip. Budgets get stretched.
And real estate. Seems like it gets hit by everything. How does high inflation affect it?
Well, high inflation often brings higher interest rates, right? So mortgages get more expensive, cooling demand for homes. Plus, inflation drives up construction costs, cement, steel, labor. That eats into developer profits, like for DLF or Oberoi Realty, and can slow down new building projects.
What about retail, especially non-essential retail?
Yeah, retailers selling things like clothes, electronics, furniture, they can really struggle. Consumers prioritize essentials. And these retailers might find it hard to pass on their own rising costs to customers who are already feeling the pinch. So margins shrink, maybe sales volumes drop for places like Pantaloons or similar chains.
Okay, so we've seen the sectors that often struggle. Now, who holds up better, or maybe even thrives when inflation is high?
Consumer staples usually show their defensive quality here. Companies selling food, drinks, basic household goods, they often have more power to pass on rising costs because people need their products. Demand stays relatively steady, so established names like Hindustan Unilever or Dabur India tend to be more resilient.
And energy prices are often a big part of inflation. Does the energy sector itself benefit?
Yes, often it does. High inflation frequently goes hand in hand with rising prices for oil, gas, coal. That directly boosts the revenues and profits of energy companies. They might be less bothered by rate hikes in that scenario, too. Think of Reliance's energy business, or ONGC, potentially doing well if crude hits, say, 8,000 euros a barrel, as mentioned in our source material.
Healthcare also seems stable with interest rates. Does that hold true during high inflation, too?
Generally, yes. Demand for healthcare, medicines, it's pretty inelastic. People need it regardless of the economic climate. Healthcare companies often have some ability to pass on cost increases, either to consumers or insurers, so they tend to resist inflation's negative effects quite well. Companies like Cipla or Apollo Hospitals usually show that stability.
And financials. We said it was a bit complex with rates. What about inflation?
Still a bit of a mixed bag. Yes, banks can benefit from the higher interest rates that often come with inflation, widening their margins. But there's a flip side. If high inflation really slows the economy down, more people and businesses might struggle to repay loans. Loan defaults could rise. So while higher rates can help earnings, worries about loan quality can temper that. But strong banks like HDFC or SBI are usually well positioned to handle it.
That gives a really thorough look at inflation's impact. Okay, let's tackle GDP now, that big measure of the whole economy's output. Can you just remind us what GDP is and why its growth rate matters so much to investors?
Sure. GDP, gross domestic product, is basically the total value of everything, all the goods, all the services produced in a country over a certain time. It's the broadest snapshot of economic health, like a national report card. In India, the Ministry of Statistics releases this data. High growth suggests a booming economy, businesses doing well, people spending. Low or negative growth signals a slowdown, maybe even a recession. Investors watch it like hawks because it tells them about the overall environment companies are operating in. That directly impacts profits and confidence.
Ms. Mancy's analysis contrasted strong growth, maybe 7% a year, with weak or negative growth. How does that difference usually play out in the stock market?
Well, there's generally a pretty strong positive link. When the economy's humming along nicely, say India's GDP is growing robustly year after year, companies usually see sales and profits rise. Consumers feel more confident, they spend more. This tends to boost investor optimism, people want to buy stocks, and prices tend to go up. So strong GDP growth in India might well lead to a rally in indices like the Nifty 50, helping big companies like Reliance or TCS.
And the opposite. What happens when GDP growth stalls or goes backwards?
Weak GDP is a sign the economy's struggling. Business activity slows down, corporate earnings might fall short. That usually makes investors nervous, more risk-averse. We could see sell-offs, pushing stock prices down. If the economy actually shrinks, like during the initial COVID shock in 2020, you can see sharp drops in indices like the Sensex as everyone braces for lower profits.
It also seems like what the market expects the GDP number to be is almost as important as the number itself.
That's absolutely right. The market is always trying to look ahead. Expectations about future growth are already kind of baked into current stock prices. So when the actual GDP data comes out, the reaction often depends on whether it beats, meets, or misses what analysts were forecasting. Even if GDP grew, but it was less than expected, the market might still react negatively. But if it comes in much stronger than predicted, that can trigger a nice rally as investors adjust their outlook upwards.
And just like with rates and inflation, GDP's impact isn't the same across the board, is it? Different sectors react differently.
Exactly. Some sectors are much more tied to the overall economic cycle than others. Their fortunes rise and fall more closely with GDP.
Okay, so let's break that down. Which sectors tend to get hit hardest when GDP growth is weak?
Consumer discretionary is usually right there at the front. When the economy looks shaky, maybe job security is a concern, people delay big purchases, buying a new car, expensive electronics, going on a big holiday, those things get put off. So companies like Maruti Suzuki, Titan, maybe Make My Trip, they feel that slowdown directly in their sales.
Makes sense. Cut back on the non-essentials when times are tough. What about industries relying on big investments like construction or manufacturing equipment?
Right, the industrials and infrastructure sectors. They're also very sensitive. These companies depend a lot on big projects, government spending, businesses investing in new facilities. During an economic slowdown, that kind of spending often gets scaled back or delayed. Fewer orders, lower revenues for companies like Larsen & Toubro or Siemens India. Think about delays in, say, a major road project.
And real estate again. How does weak GDP affect property?
Weak GDP usually means less demand for property, both homes and commercial spaces. People are hesitant to make huge investments like buying a 50 lakh flat if they're worried about the economy. Businesses put off expanding into new offices. Plus, banks might get a bit tighter with lending in a slowdown. All bad news for developers like DLF or Godrej Properties.
We also mentioned tax sensitivities. How does weak GDP specifically affect technology companies?
It varies a bit within tech. Some essential software or cloud services might hold up okay, but the growth-focused tech companies, they can be vulnerable. Their expansion often depends on businesses spending more on new software, IT upgrades, digital projects. In a slowdown, businesses often cut back on that kind of spending. That hits revenue growth for firms like Zomato or maybe smaller IT firms. Companies might delay signing those big, say, 10 crore software contracts.
Okay, so those are the sectors that really feel the pain when the economy slows. What about the ones that are more resilient, the defensive plays?
Well, you can probably guess by now. Consumer staples again. People still need to buy food, soap, basic necessities. Demand stays pretty stable even when GDP growth is weak. That helps companies like Hindustan Unilever, ITC, or Dabur India. Sales of those 50 toothpaste tubes tend to hold up.
And healthcare seems to be consistently stable across these scenarios.
That's right. Need for healthcare doesn't really follow the economic cycle. People get sick, need medicine, regardless of GDP numbers. So that provides stability for companies like Cipla, Dr. Reddy's, Apollo Hospitals. Demand for that U1000 prescription remains fairly constant.
Utilities, too. Power, water, essential services.
Yes, exactly. Demand for electricity, water, it's quite predictable. Households and businesses need these things day in, day out, even in a downturn. That stability, often combined with regulated pricing, makes utility companies like NTPC or Adani Power more resilient. People still pay their 5,000 monthly power bills.
And financials. We had a mixed picture before. How do they typically handle slow GDP growth?
It's still a bit mixed. On one hand, basic banking services are always needed. But a significant slowdown means more risk of loan defaults. Businesses might fail, individuals might lose jobs and struggle to pay back loans. That hurts bank profits. So while they're essential, they aren't totally immune. But well-run, stable banks often weather slowdowns better than highly cyclical sectors.
So understanding GDP gives us that a broad economic health check, but again, you need to look at how different sectors react. Okay, let's move to our final big area, the impact of government and RBI policies. These seem like they can have a really direct, sometimes sudden effect. What are the main types of policies we should be watching?
Broadly, you've got government policies and RBI policies. Government policies include fiscal policy, that's decisions on spending, taxes, government debt. Think budgets, infrastructure projects, subsidies, tax changes like GST, and also regulatory policy setting rules for industries like environmental laws, import duties, things like that. Then you have the RBI, focused mainly on monetary policy, managing interest rates, the money supply, bank lending rules, plus regulating the banks themselves. And yet these policies are hugely powerful. They set the stage for how businesses operate, affecting costs, sales, ability to borrow, growth plans, all of which feeds directly into investor sentiment and stock prices.
Can you give some specific examples of how, say, a government policy might hit the stock market?
Sure. Fiscal policy first. If the government announces a big push in railway spending, like we saw mentioned with recent budget allocations, that could directly benefit companies in railway construction or engineering, maybe boost their stock price. IRCTC was mentioned as an example. On the flip side, if the government hikes taxes on something specific, like tobacco, that could hurt the profits and stock price of a company like ITC. Regulatory changes too. Stricter pollution rules could raise costs for manufacturers. Changes to GST on cars could impact auto sales. It's quite direct.
And RBI policies, how do their actions ripple through?
RBI actions, especially on interest rates, are very direct. When the RBI raises the repo rate, like in 2022 to fight inflation, borrowing gets more expensive across the board. For businesses, for consumers buying on loans, that tends to slow down the economy, put downward pressure on stocks, especially those reliant on debt or consumer spending, like startups or auto companies needing cheaper car loans. Conversely, if the RBI cuts rates, borrowing gets cheaper, potentially stimulating spending and investment, giving the market a boost, and their management of money supply and bank rules is vital for overall financial stability, essential for a healthy market.
It also feels like just the signals from the government or RBI can move markets, even before action is taken, affecting confidence.
Absolutely. Policies are huge signals about the future. If the government announces pro-business reforms, maybe tax cuts or deregulation, that can create optimism, encourage investment, lift stocks. But if there's policy uncertainty, maybe delays in reforms, or hints of tighter regulations or unexpected tax hikes, that creates anxiety. Investors might sell first, ask questions later. Just think how markets react to whispers or hints about what the RBI might do with interest rates next. Sentiment shifts quickly.
And sometimes policies come out of the blue, right? Causing really big immediate reactions.
Yes, policy surprises can have a dramatic impact. Demonetization in 2016 is a classic example. That unexpected move hit consumer spending hard almost overnight, and consumer-focused stocks took an immediate dive because cash just vanished from the system temporarily. An unexpected cut in subsidies for, say, fertilizer could hammer fertilizer stocks. An unexpected rate cut could spark a huge rally. Surprises matter.
Okay, so knowing how these policies work, which sectors tend to suffer most when policies get restrictive? Think higher taxes, tighter rules, RBI hiking rates.
Consumer discretionary often gets hit hard again. Higher taxes on non-essentials reduce spending power. Higher interest rates make loans for cars or appliances more expensive. So demand drops, hurting companies like Maruti Suzuki or Titan. If GST on certain goods goes up or car loans get pricier, they feel it.
And real estate consistently seems vulnerable.
Indeed. Higher interest rates from the RBI directly cool the housing market more expensive home loans. Government actions like stricter land regulations, higher property taxes, or removing tax breaks for home buyers also hurt. Affects developers like DLF, Oberoi Realty, and buyers alike. Maybe makes that home loan interest deduction less valuable.
Growth-focused tech companies, too. Why do they struggle with restrictive policies?
Well, many rely on borrowing for growth, so RBI rate hikes make that funding more expensive, slowing them down. Government rules, maybe stricter data privacy laws, can increase their compliance costs, eating into profits. Plus, in uncertain times caused by policy shifts, investors often get wary of riskier growth stocks. Valuations can fall. Companies like Zomato or Paytm might feel these effects from rate hikes or new compliance rules.
What about the big infrastructure and industrial players?
They can be quite vulnerable too. If the government cuts back on infrastructure spending to tighten its belt, that means fewer projects. If RBI rate hikes make financing those huge, expensive projects much harder, that also slows things down. So companies like Larsen & Toubro or GMR Infra could suffer if, say, road budgets are cut or borrowing costs shoot up.
All right. On the flip side, which sectors tend to navigate restrictive policies more smoothly?
Again, consumer staples often prove resilient. People still buy basics, even if taxes edge up or rates rise slightly. These companies, like Hindustan Unilever or ITC, often have the pricing power to pass on some cost increases without losing too many customers.
And healthcare. Does its essential nature help here too?
Yes, Demand for healthcare tends to stay steady regardless of most policy shifts. Sometimes government policies can even help, like schemes aimed at increasing healthcare access, perhaps like Ayushman Bharat potentially boosting certain providers. So companies like Cipla or Apollo hospitals often hold up relatively well.
Utilities as well. Steady demand.
Correct. Electricity, water, they're essentials. Demand is stable. Plus, they often operate under regulated pricing structures, which offers some protection from policy shocks. Helps companies like NTPC or Adani Power.
And finally, financials. We know rate hikes can sometimes help them. How do they generally fare under restrictive policies?
It's interesting. Higher interest rates from restrictive RBI policy can boost bank profits through wider margins, as we discussed. But the risk is if those restrictive policies trigger a sharp economic slowdown, leading to more loan defaults, that would hurt them. So it's often a balancing act. But well-capitalized banks like HDFC Bank or ICICI Bank are usually robust enough to manage these shifts.
This has been, wow, incredibly insightful, really mapping out those connections between the economy, policy, and the market. To wrap things up, what are the absolute key takeaways you think our listeners should hold on to?
I think the main thing is this. Those big economic numbers, rates, inflation, GDP, and the decisions made by the government and RBI, they are incredibly powerful forces shaping the stock market.
Yeah.
But, and this is crucial, their impact isn't monolithic. It hits different sectors very, very differently. Understanding that variation is key.
And what core ideas should someone keep in mind when they're trying to make sense of the market's movements?
It's really about grasping these underlying dynamics. Knowing, for example, why rising rates might pressure tech but help banks, or how inflation can hurt retailers but potentially benefit energy producers, understanding how GDP links to cyclical sectors, and seeing how different policies create winners and losers across industries. It just provides essential context, helps you analyze the why behind market moves and make more informed decisions. It's like feeling those different economic pulses.
That's a fantastic summary. Thank you. And just one final thought for you, our listener, to mull over. In today's world, everything's connected, right? So how might unexpected global events, things happening completely outside India's economy, or policies, how might they dramatically amplify or maybe even dampen the effects of these domestic factors we've discussed today on the Indian stock market? It's just a reminder of that bigger picture, that complex web of influences, something to keep thinking about. Thanks so much for joining us for this deep dive.